Hello everyone. So now we welcome Mr. Amit Tripathi, CIO Fixed Income, to talk about the year gone by.
Good morning viewers. I'm here to give you a macro recap for 2024 as well as a debt market recap and possibly try and crystal gaze into 2025 as we move towards the year end. I guess 2024 has been a year of domestic resilience and global divergence. We have seen economies like the US chugging along pretty nicely, whereas we have seen other larger economies like China and parts of Eurozone struggle through the course of the year. India, though, has been maintaining its pace of reasonable growth and anchored inflation expectations. Coming back to the US to start with, I guess the story has been a combination of what has been called a new era of productivity growth, capex coming back to onshoring, the fiscal excesses of the past still prolonging, and a good consumer balance sheet on an overall basis. Whereas we have seen other large economies such as China, etc., while maybe gaining on a productivity levels, but still struggling with overcapacities both on the commodity side, base metal side, as well as in many other manufacturing spaces. India has been a resilient space, which I mentioned for most part of 2024. The macro improvements have continued. In fact, the macro improvement story of India is now a story which is more than 3 years old. Right from the post-COVID period, we have seen both the fiscal and the current account shaping up really nicely, both quantitatively as well as qualitatively. It has had a direct impact on core inflation. Core inflation has now sustained at around 4% levels, or in fact lower than 4% levels for more than 12 to 18 months now. The noise around food inflation, though, has continued, which has created some issues as far as the conduct of monetary policy is concerned. Within food inflation also, it is primarily vegetable price inflation as well as protein inflation, which has been on the higher side. Whereas if you actually look at the core food basket of cereals, pulses, etc., that has been much more well behaved. A lot of resilience that we saw in the initial post-COVID part of growth as far as India is concerned, something that the RBI has taken a lot of comfort and confidence from, actually came from a strong urban consumption that we saw. Many people called it a K-shaped recovery. It continued well into the beginning of this year. It is only in the later part of this year, especially in the second half of this calendar year, that we have seen some kind of a slowdown in urban consumption, possibly led by multiple factors, including slightly higher inflation as far as the consumer basket is concerned, as well as contained or slowing wage growth. On the other hand, the good news is coming from the rural side as we speak. Rural demand is starting to inch up. You have had the second reasonably successful monsoon, and as we go forward, this not only augurs well for rural consumption trends per se, but possibly also for food inflation as far as 2025 calendar year is concerned. Going back to the core inflation point and the fiscal and current account point, as we mentioned earlier, right from 2021-22 onwards, the government has done its bit in terms of choosing fiscal consolidation over expansion in the post-COVID environment. And what is good to note that this has not come only in quantitative terms, but more importantly in qualitative terms. Capex has been given a thrust, whereas revenue expenditures have been pretty well controlled. On the current account side also, if you actually look at what is happening, you are seeing a reasonable pickup in manufacturing exports led by electronics and other key manufacturing items, and you have seen a surge in service exports. This has more than made up for any increase in imports, whether to do with gold and oil or whether to do with core imports per se. As a result, we would be ending this year below the budgeted numbers mostly as far as fiscal deficit is concerned, and at around the 1% mark as far as the current account deficit is concerned, which clearly is the third year in a row where we would have met or exceeded expectations as far as this consolidation is concerned, and core inflation has been a direct fallout of that. The segment of the market which has best reacted to this consolidation is the longer end of the yield curve as far as debt markets are concerned. We have seen long-term yields coming down from a high of 70-75 in calendar year 2023 to below 7% or around 7% as we close this year. The shorter end has though not kept pace with the longer end in the last 12 to 18 months, and the reasons are very simple to explain. We have seen growth being maintained at reasonable levels through the course of this calendar year. As I mentioned earlier, it is only in the second half that we have seen some mixed signals, especially coming from urban consumption side. There has been some delay, possibly in some cases due to elections or some other local reasons on the capex spend this year vis-a-vis what has been budgeted, and this slowdown has shown in terms of especially the Q1 and Q2 GDP numbers. Although there are other indicators to show that activity levels are still panning out. Net, so to say, while the growth resilience remains, you may see some kind of incremental slowdown continue into 2025 as we move forward. The RBI has started taking cognizance of that. Very frankly, as far as the growth, sustainability or resilience was there, the RBI was not really worried about any kind of additional monetary support being needed by the economy. But as we have seen things starting to incrementally change, the RBI changed its stance in October, did a CRR cut in December. As we go into 2025, there are possibilities that once food inflation starts coming down, aided by a good monsoon, we may see a series of further monetary easing steps being taken by the RBI. And this is where the parts of the debt markets which have not really participated in the rally caused by fiscal and current account consolidation, which is the short to medium part of the yield curve, is most likely to join the performance or the good performance that we have already seen at the longer end of the yield curves. When we think about the bond market prospects of 2025, from a policy standpoint, we expect the RBI to be incrementally taking more steps from a monetary easing standpoint and from a liquidity standpoint. Liquidity is one of the biggest drivers as far as aiding the short to medium term part of the yield curve is concerned, and that is something that we are likely to see more and more in 2025. Second, the absolute yields, given that the rally that we have seen at the longer end, given that the spread widening that we have seen in corporate bonds versus G-Secs, although that spread widening also has come for the right reasons, has all led to a situation where the 3 to 5 year part of the corporate bond curve, for example, or the 5 to 10 year part of the G-Sec curve, for example, clearly offers reasonably good value at this point in time. Within the corporate bond space, again, depending on individual investors' risk appetite, you could actually start from the very high-end AAA PSU space and go right up to the AA and single A space, depending on how you're looking at constructing and maintaining your portfolio through 2025. From our perspective, the confidence that we get in terms of the balance sheets of India Inc., including that of non-financial companies, gives us the confidence that they will be able to sustain the short-term vagaries through the economic cycle. Across corporate balance sheets, whatever exposures one takes in reasonably good quality companies is likely to perform well as far as that exposure is in this segment, which will be aided by A, better liquidity conditions going forward, B, incremental easing by RBI, and C, the good spreads or the attractive spreads at which we are starting. So from a core portfolio standpoint, when one looks at it from a 12-month perspective in 2025, one would want to remain overweight in the intermediate part of the yield curve, which I just defined as being 3 to 5 year corporates, 5 to 7 year G-Secs, etc., etc. And within that, the relative credit quality or the relative credit composition will be a function of the investor's individual risk appetite. While this is the 12-month story, one should not lose sight of the big picture. And the big picture is that India has seen significant amount of macro resilience in the last 3 years. We believe that this macro resilience will continue to be there going forward. And hence, for any long-term investor who is looking to invest into fixed income in India, allocation to long bonds should always form a core part of the portfolio. So while tactically for 2025, it is overweight the intermediate segment, If you are an investor who has a 3 to 5 year or a longer kind of a time horizon, it is but imperative that you have some kind of a core allocation to long-term bonds as far as your overall bond allocation is concerned. I would want to wish all of you a very, very happy new year, good tidings over 2025, and we hope to see you on the other side pretty soon. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.